Have you ever just stared at a stock chart and it looks like nothing but a bunch of random chaotic squiggles? Well, today we're going to cut right through that chaos. We are going to break down how to spot clear, actionable market trends and turn all of that noise into a real, usable trading advantage. If you've ever felt totally overwhelmed looking at a chart, like you're just staring at a meaningless line, you are definitely not alone. It's a really common feeling. But what if I told you there's actually a hidden structure in all that chaos, a clear signal just waiting for you inside all that noise? And that signal? Well, it's called a trend. And a trend is really just a period where the market has a directional bias. It's an area of relative certainty in what feels like a totally uncertain world, a place where the odds are actually tilted in one direction. And our job as traders is to learn how to spot it. All right, so our first step is to find that order in the chaos. And we're going to start with the most direct method there is. Just looking at it. Seriously, you can learn a surprising amount just by training your eyes to see the bigger picture. So here's the most basic test of all. I want you to just step back from the screen for a second. Does the price, generally speaking, move from the bottom left corner up to the top right? That's probably an uptrend. Or does it go from the top left down to the bottom right? Well, that's a likely downtrend. It's kind of like the 10,000-foot view, and you'd be amazed how effective it is. Okay, let's zoom in a little bit closer. A trend isn't just a straight line, right? It's more like a staircase. A really healthy uptrend makes a series of higher highs and higher lows. It goes up, pulls back a little, then goes up even higher. This shows that buyers are consistently stepping in at higher and higher prices after every little dip. And a downtrend? It's the exact opposite, a staircase heading down, made of lower highs and lower lows. Recognizing this simple rhythm is, well, it's the absolute foundation of trend analysis. And this brings up a really great psychological clue. In a strong trend, you actually feel a sense of urgency. You get this feeling like the market is running away without you, and you're just sitting there hoping for a small dip, any little pullback so you can jump on board. Now, if you just feel confused and uncertain, you're probably in a sideways market, not a real trend. That feeling of urgency, it's a powerful, powerful tell. Okay, so we've looked at the big picture. Now let's grab our magnifying glass and zoom right in, all the way down to the individual price bars. By reading the story told by the candlesticks themselves, those little red and green bars, we can find some powerful clues about the trend's real strength. In a really healthy trend, you're going to see these specific clues. First, most of the individual bars are trend bars, meaning they close decisively in the direction of the trend. No messing around. You'll also see 3, 4, maybe more bars in a row, all closing higher and higher in an uptrend. There's also very little overlap between the bodies of these bars. They look like they're marching confidently in one direction. And finally, you'll see small tails or wicks on the candles. That shows strong conviction. It means there isn't a lot of pushback coming from the other side. So now that we know what to look for with our eyes, let's add some professional tools to our toolkit. These indicators are going to help us quantify the trend and confirm what we think we're seeing, which helps take some of the guesswork out of the equation. A moving average is one of the most reliable tools in the box. Just think of it as a smoothed out price line. We don't need to get lost in the math here. The only thing that really matters is the slope. Is the 20-period moving average pointing up? Well, the short-term trend is bullish. Is it pointing down? Then it's bearish. It's really as simple as that. And here's a great way to measure a trend's momentum. In an exceptionally strong trend, you'll often see 20 or even more consecutive price bars that are so powerful they don't even pull back enough to touch the 20-period moving average. When you see that, you're looking at a market with incredible power and urgency behind it. Next up is the good old trend line. For an uptrend, you start by finding those significant pivot points, the swing lows, where the price dipped before it turned back up. Find at least 2 of these that are getting progressively higher, and then just connect them with an upward sloping line. This line, it now acts as a visual guide for the trend's support. And as long as the price stays above it, that trend is considered good to go. So once you can identify a trend, the next step is recognizing its specific pattern. See, trends often form these predictable structures, and learning to spot them can really help you anticipate what might be coming next. Right, so trends don't all look the same. They often fall into one of 4 common patterns. You might see a trend from the open, which is just a relentless one-sided move right from the get-go. Or you could see a spike in channel, which starts with this explosive move and then settles into a calmer angled channel. You also have trending trading ranges, where the market moves up, pauses in a sideways box for a bit, then breaks out to a new higher box. And finally, the stairs pattern, which is a broad, orderly channel with multiple swings up and down. Recognizing these patterns helps you understand the personality of the trend you're actually trading in. So finally, how do we confirm a truly powerful, long-term uptrend? The kind driven by the big institutions? For this, we can use a checklist from a methodology called stage analysis, which is designed specifically to identify stocks when they're in their absolute strongest phase. This checklist here, this defines what's known as a stage 2 uptrend. And I want you to notice how everything is perfectly aligned. The price itself is above all the key long-term moving averages. And, just as importantly, those averages are stacked in the correct order, with the shorter-term ones on top of the longer-term ones. And they're all pointing up. This isn't just a short-term rally. This is the picture of a confirmed, healthy, long-term uptrend with broad market participation behind it. And that really brings us to the most important takeaway of all. Why does any of this matter? It's because of inertia. A market in motion tends to stay in motion. Most attempts to fight a strong trend are gonna fail. They just become little pauses or pullbacks before the trend takes off again. The highest probability play is always to follow the trend. So we've gone from seeing chaos to identifying structure, from candlesticks to moving averages, and finally to confirming major market advances. The tools, they're now in your hands. So the only question left is, now that you can see the path of least resistance, are you going to follow it?